Business owners think that financial statements are just boring paperwork for taxes. But these reports are like an X-ray of your entire business. If you cannot read them properly, you're flying blind. Imagine your revenue is in the $2 million range, but you only have $5,000 cash in your bank account, and you have no idea what went wrong. It's actually way more common than you think. Today, let's go through the complete journey of somebody who went from
just one new customer
to
things will be fine.
By the end of this video, we'll not only solve a financial mystery together, but I'll also teach you how to do this yourself in your business just using your financial statements. By the way, I'm Alex. I've been in accounting and finance for over 15 years. I have top professional designations, and helping business owners solve financial challenges is what I love doing most. Financial statement analysis can become very technical very quickly. So to make it simpler, let's imagine a business owner, let's call him Joe, who's been running in circles trying to solve an apparent mystery.
My revenue keeps going up, my marketing is working, and my profit is solid, but I barely have any cash left. What is going on?
Sound intriguing? And this is exactly the kind of mystery that can be solved through proper financial statement analysis. But first, let's clarify some terms. Each line on your financial statements is called a line item. And the financial statements will have rows for each line item and columns for the time periods the numbers represent. You can analyze the numbers in three unique ways: horizontally, vertically, and by using a cross-statement method. Horizontal analysis means you're looking at the same line item across different time periods. Vertical analysis means you're comparing different line items against each other within the same period. And cross-statement analysis means you're connecting the line items across different statements. We'll discuss how each method reveals different clues about what was really happening in Joe's business. But the first step was to start looking at the financials.
Have I looked at the financials? I mean, yeah, but I'm not an accountant. Revenue grows. Company is profitable. What do I know?
At first glance, his income statement looked maybe okay. Revenue indeed grew from $2 million to $2.2 million. That's a 10% increase. Net profit is still positive, everything is great, right? But instead of jumping to conclusions based on just two numbers in one financial statement, let's start with horizontal analysis and look at the year-over-year changes first. Horizontal analysis compares your numbers across different time periods. It's called horizontal because of how you're looking at your line items. If you're analyzing revenue, you only look at revenue from period to period. Most businesses will use only two-period comparisons, either year-over-year or month-over-month. Year-over-year eliminates seasonal impact. It's great for strategic planning and identifying long-term patterns. Month-over-month catches trends quickly but has more noise and ups and downs.
Looking at the financials monthly. No way, there is way too much noise. Nothing ever makes sense to me.
Quarterly is also very common, and you can create custom periods if it makes sense operationally. But what exactly are you looking for in horizontal analysis? Because it reveals trends, you're looking at the rate of change and consistency of the changes as well. The rate of change is usually shown in percentages instead of dollars. To calculate the percentage change for any line item, subtract the prior period from the current one divided by the prior period and multiply it by 100 to get the change in percents. So let's look at Joe's numbers. His revenue went from $2 million to $2.2 million. That's a 10% increase. It's $2.2 million minus $2 million divided by $2 million times 100. That looks like good news, right? But his cost of goods sold also rose from $1.2 million to $1.5 million. That's a 25% increase. By the way, if you're not sure what cost of goods sold is, I recommend watching part 1 of this video, where I explain the 3 financial statements and key line items in detail. And this is where things start becoming interesting. It's not enough to just look at one item. Real insight comes from comparison. Why does revenue grow 10% but cost of goods sold grows 25%? Is it because the suppliers increased their prices and Joe didn't raise his, or maybe he changed to a supplier who now charges him more for the same products? If you can explain the reason, great. Then you can make an educated decision on how to proceed, but if you don't, that's a problem.
I'm not sure. Inflation, maybe? Everything is more expensive now.
This is how this analysis can reveal operational problems before they become critical issues, especially if you look at them on a monthly basis. Marketing expense also changed dramatically in Joe's business. They went from $50,000 to $150,000. That's a 200% increase. But revenue only grew by $200,000. In most cases, your return on marketing should be much higher than just 2 times revenue increase. And that was another red flag. Joe's payroll also jumped from $120,000 to $250,000, more than doubled. Did he hire more people or raised salaries aggressively? As a result of those major cost increases, operating profit dropped from almost $500,000 in the year before to about $150,000 this year, a 70% decline despite growing revenue. And similar to the income statement, balance sheet can be analyzed horizontally as well. Balance sheet trends often predict income statement problems, so it's usually analyzed together with the income statement. But here are still a few critical items to keep an eye on. Joe's cash dropped from almost $350,000 to just $5,000. That's a 99% decline. But accounts receivable, which shows what his customers owe him, skyrocketed from $25,000 to $225,000, a crazy 800% increase. Inventory grew from $50,000 to $150,000, up 3 times, again outpacing sales growth. There is really no rule of thumb for what a reasonable change to each line item should be. As long as you can explain every variance or lack of variance, you're on the right track. But horizontal analysis alone, while very powerful, may still not be enough to see the full picture. So let's talk about the next method, vertical analysis, and see what more it reveals about Joe's business. Vertical analysis takes a completely different approach. Instead of comparing numbers across time periods, you compare line items against each other within the same period, vertically. For the income statement, everything usually gets compared to revenue, but sometimes you might use other baseline like gross profit. For the balance sheet, total assets is a common denominator, but there are several ratios that use a different base depending on what you're analyzing. So let's go back to Joe's income statement. If his revenue is $2.2 million and his cost of goods sold, or COGS for short, is $1.5 million, then COGS represents about 70% of his revenue, and his gross profit is $700,000, or about 32% of his revenue. You calculate those percentages by dividing COGS and gross profit by his total revenue. That 32% is also called gross profit margin. And you will see that whenever a subtotal on the income statement is shown as a percentage of revenue, it's called a margin. But looking at these numbers in isolation might not reveal much as well. It's the trend in those margins as well as industry comparison that matter. If we look at Joe's statements vertically, you will see that his gross profit margin dropped from 40% last year to about 30% this year. Not only was the margin shrinking, but it was now at the lower end of the industry average of 30% to about 50%.
Seriously, huh? That is low. Why is that so low?
Marketing expenses made up almost 7% of revenue this year, which is on the higher end of the industry range of the company of his size. Last year, it was just 2.5%, and historically, Joe never spent more than 5% of revenue on his marketing efforts. As you can see, you're not just looking at revenue or marketing horizontally anymore. You now add a vertical component to the analysis. Payroll also grew to about 11% of revenue from 6% a year ago, which also looked like an outlier. Is Joe building extra team capacity because he anticipates higher growth in the near future, or is his team just less efficient? And that's where KPIs start to matter. KPIs, which stands for Key Performance Indicators, are one of the most important topics in business. Without KPIs, managing business effectively and setting goals is extremely difficult and would require a lot of management's time. KPIs can really streamline your management efforts, make the company more transparent, and reveal problems early. By the way, if you're interested, I recommend watching the next video where I take a deep dive into how different KPIs work and how to design them properly. And if you want to start tracking KPIs right away, we've compiled a free guide with over 100 KPIs from basic to advanced, organized by category with complexity ratings, and you can download it absolutely free from our website. The link is in the description.
You know, they don't teach this at school. I mean, the basics, yeah. But all that finance literacy is not easy. So you just avoid it at all costs.
Going back to the vertical analysis, let's look at Joe's balance sheet now. Most balance sheet vertical ratios can be grouped into two categories: liquidity and leverage. On Joe's balance sheet, cash flow made up less than 1% of total assets, practically gone. Receivables increased as a share of assets from 5% to over 40%. Inventory also rose from 10% to about 30%. Meanwhile, liabilities now make up 2/3 of assets, up from 1/3 just the year before. And, of course, Joe's interest expense reflects that on his income statement. These numbers show Joe's liquidity position, how quickly he can convert assets to cash to pay his bills. With only 1% cash and 40% tied up in his receivables, what does it say about his balance sheet? Well, if shit hits the fan, Joe is in big trouble. As you can see, something fundamental has changed in Joe's business. More money was tied up in receivables and unsold product, less was held in cash, and expenses were eating into margins from multiple angles.
I honestly can't believe how deep in the hole we are. I thought things were fine, but the reality is, we are barely keeping the lights on.
Horizontal analysis showed us that costs were growing faster than revenue. Vertical analysis revealed shrinking margins and dangerous asset shifts. But to see the complete picture, let's look at all statements together. Cross-statement analysis is where you connect the dots between all three financial reports, and it's often where the biggest red flags show up. Joe's business reported $100,000 in net income, yes, but his operating cash flow was negative $145,000. The difference was explained by two major items: a $200,000 increase in receivables, which was suspiciously close to the entire increase in sales, and a $100,000 increase in inventory. In other words, money was earned but not collected, and more product was being purchased than sold. But that wasn't all. The company also spent $115,000 on some new equipment, and Joe issued $250,000 dividend to himself. In part 1 of this video, I talked about how dividends are part of the retained earnings, which is a balance sheet item, not an income statement expense. So Joe didn't even see his dividend on the income statement. While his income statement showed profit, his operations lost $145,000 of cash. Another $115,000 went to purchase equipment, which is an investing activity on the cash flow statement, and $250,000 in cash was taken out by Joe as dividend, which is a financing activity. That's how the company went from $345,000 cash in the bank to just $5,000. And the only thing that kept the company alive was a $250,000 bank loan and credit cards that were almost maxed out. So revenue was up, but profit was down. Cash was gone, receivables were unusually high, inventory was sitting unsold, and the business was barely staying afloat by borrowing money. This wasn't cash flow, this was cash no. We know something is off, but what? Have there been shifts in strategy, new product, new team?
Well, yes, we did hire a new marketing director last year, a really smart guy, well connected in the industry.
And that's when the pieces clicked into place. The new director came from a much larger company. He was smart, confident, full of ideas, and eager to make a big impact. He pushed hard into rebranding campaigns, digital ads, and trade shows, trying to get the business in front of major retailers. The ad spend alone tripled, but it didn't generate any wins. Then, looking for at least some results, the director went to his ex-colleague and a friend who ran a large retail chain. The friend agreed to buy a $250,000 order, but only paid $50,000 so far, promising to repay the whole amount soon. The marketing director took that early payment as a green light and started ramping up inventory and pressing existing suppliers to send more raw products because more big orders were coming. Inevitably, the price of raw materials increased substantially as a result of their rushed orders. But the big wins did not materialize. All those marketing efforts resulted only in one new customer.
Just one new customer? Oh, come on.
So the company was left holding an extra $100,000 in unsold product and a $200,000 accounts receivable balance that still hadn't been collected. And Joe, he saw revenue going up and assumed that strategy was working, fully entrusting his marketing director to run things as he saw fit.
Everybody tells you, you gotta delegate, but I get it. You still need to keep an eye on the KPIs.
If you know another business owner who's delegating like this, please share this video with them. It might prevent them from going through what Joe experienced. Unfortunately, Joe's story is far from unique or extreme. So many business owners learn to pay attention to their financials the hard way. Trying to delegate without the proper controls in place can make it very easy to lose track of strategic slips happening right under your nose. So keeping an eye on financials and regularly performing analysis and looking at your company's KPIs is critical.
The takeaway? Learn to read those financials or hire somebody who already knows how to. Seriously, guys, won't hurt you for sure.
I hope this two-part series helped you understand your financial statements better. And if you learned just one thing, that makes it worthwhile. As you know, running a business is extremely challenging, and business owners like Joe are usually incredibly bright, driven with years of experience, but also get pulled in multiple directions all the time and lose their focus. If you find these videos useful and they help you regain that focus, please consider subscribing not to miss future updates. Of course, you don't have to, but I thought I would humbly ask anyway. And please let me know if you liked or didn't like something in this video in particular. And please be honest. My goal is learning from your feedback and creating better content, which is getting more likes. If there is another topic or business challenge you would like to learn more about, please let me know in the comments. Every business faces challenges, but with the right knowledge, every challenge has a solution. Thanks for watching, and see you next time.
Well, it is what it is. At least now I know the reason and how to fix it. Things will be fine. We'll be fine.